Well, good morning. This is Chuck Burwell again. I want to welcome all of you for this webinar here this morning, as we are going to be talking about something that is near and dear to all of us, which is dealing with those wonderful folks over at the IRS. We thought it would be appropriate this time of the year to perhaps give some information out about our little friends back at the IRS and how you can actually use them to help coordinate your purchase of any equipment that you're looking to incorporate into your existing business or even a new startup business. And that is called using that IRS tax code to actually help pay for the equipment so that you have a faster return on your investment. Today, introduction-wise, as I said myself, I'm Chuck Burwell. I'm a regional sales manager here. I also want to make it very clear, I am not a tax professional. I am not a CPA. I don't practice any type of tax consulting business, nor does anybody here at our company. The purpose of this webinar is to provide you with information that you can use as you're looking at your business for purposes of acquiring more equipment, be it with us or any other type of equipment you're bringing into the business. And these questions that you have from here should actually be directed to your own CPA or tax advisor. So again, I want to make that very clear up front. What we are passing along here to you today is general information, thought-provoking, giving you insight as to how you can use the tax code to your own advantage. But for more specifics beyond this discussion today, I would refer you back to your own tax professional. We're going to look at something called the IRS Section 179 tax code provision. We'll look at the history of that, where that started, how it came to be. Then we're going to slide into what actually qualifies, what kind of equipment, how this has to be spent. We're going to talk a little bit more about how it does work. And then for more specifics, we want to give you an example of how the savings can actually benefit you and your business, as well as we have some general questions that we have put together here ahead of time that I think will answer many of the questions you might have. But for purposes of this webinar, if you have specific questions, go ahead and write those in. All of you are not capable of interacting with me verbally, but you can interact by entering in your questions. I have them here on the screen in front of me. I'll be able to answer those as we get to the end of the webinar. Our plan here is to have you out of here in no less than 40 to 45 minutes from this time, inclusive of the Q&A. We value your time. We value your presence here. This is not an all-day thing, and we want to provide you with information that will help make your initial business stronger or make your existing business even better as you head into 2016. So let's start with just the history of the IRS Section 179. Many of you will probably recall, not too long ago, 7 lovely years ago, we were in a very, very big, some will call it a recession, others will call it a depression. And as a result, the government created what was called the Economic Stimulus Bill. This was in 2008. The purpose of the bill, as some of you will also recall, was it was supposed to be a jobs-ready program to invigorate the economy, get things moving, because the country had pretty much come to a standstill. Real estate was crashing, jobs were going overseas, layoffs were just abundantly becoming a household word all the time, and people were in fear of where things were going. So as a result, this economic stimulus bill was put into place. And it was intended to help, as we say here, to jumpstart the economy. Now, one of the most interesting things that was in this thousands and thousands of pages of the bill itself was something called the IRS Section 179. The purpose of it was to both encourage manufacturing production and for business expansion. The belief being that if we as a country can get our manufacturing enterprises to start creating more, while at the same time giving incentives to business to acquire those products and incorporate them into their own business will get a twofold approach by increasing revenues, adding people to payrolls. Those payrolls transcend into salaries and monies that flow back into the economy, and at the same time giving businesses the ability to pay in a faster turnaround time for the necessary assets that they needed for their business itself. And as part of that, what was written into this IRS 179 code was for the purposes of accelerating tax savings. As we all know, when you start a business or have an existing business, you have revenue and you have the expenses associated with it, such as your labor, your supplies, and what have you. But when you acquire actual hard products, assets that you use, cars, machinery, other things of a tangible aspect, those things don't get initially expensed. They have to be amortized or depreciated over a period of years, and it's usually 5 to 7 years for the most part. So in their wisdom, when they created this economic stimulus bill, they decided, let's accelerate that so that businesses will have the ability to write these hard purchases off faster, more as an expense, if you will, as opposed to depreciating them out over a 5 to 7 year period of time. And at the same time, the thought was, if businesses can do that with the acquisitions of those assets, production companies, people that produce the equipment that is being purchased, will have more sales. Specifically, what you want to look at for what qualifies for a Section 179 deduction is tangible personal property. As I mentioned earlier, we were coming off of a bad situation from the early part of the new century, where real estate was falling rapidly. And so the incentive was not to encourage people to have ways to go out and reinvest or to buy more real estate. The desire was to create the acquisition of more machinery and equipment. So when you're looking at a Section 179 deduction, you are talking about tangible personal property, things that you actually can hold and feel. These are not licenses. These are not intellectual properties and the like. It is things that you go out where somebody manufactures, they produce, they ship it to you, you pick it up, you put it into your business, and things that, as I said, normally would have been written off in about a 5 to 7 year period of time. So what you're wanting to look at as you get towards the end of 2015 is, if I'm going to invest in my current business or I'm going to invest in a new business, and I have limited funds, where do I want to spend the money? How am I best going to recover that investment as quickly as I can? And what's going to be the most beneficial for either my new business or existing business? As I mentioned earlier, typical businesses will take an asset that you buy $30,000, $40,000, $50,000, and you have to depreciate it over a period of time, generally around 5 to 7 years. So let's just take $30,000 as an example. That says if you go out and buy a $30,000 widget maker and you depreciate it over 5 years, you only get to offset $6,000 a year against the revenue in that year. That gives you an even spread over the period of time. Section 179 says, no, we're going to allow you to accelerate that even faster. We want you to offset that sooner, because what that ultimately is going to do is, on the front end of your business, whether it's current or a new business starting up, you're going to be able to reduce the exposure of income to taxes. This will allow you, as you'll see in the example later, to reduce your tax liability. Now, one of the things they did initially, when you go out and you look at the original economic stimulus bill, is in addition to Section 179, there was also something called bonus depreciation over and above. There was a graduated program through the bill that said we'll allow for bonus depreciation starting in years 2008 and going forward. Unfortunately, when it came to 2015, no bonus depreciation was allowed. So the only thing that is available in 2015 is the Section 179 write-off. And what that does is it reduces federal taxes for 2015. And it could even be beyond 2015, which we'll talk about in a little bit. But just know that for purposes of 2015, this will allow you to accelerate depreciation far faster than what you would normally under most business structures. Also keep in mind too, this ends in 2015. Currently, there's talk and discussion in the Senate and in the House of creating a bill that will take this beyond into 2016 and further. But at this point, it's all talk. There has not been any bill presented. There's nothing in a committee. There's nothing going forward. The thought was in 2008, we don't want this to become part of our fabric forever, that we would just take it over a period of time, allowing us to jumpstart things and phase it out. Also, by doing this, you'll see this term ROI, return on your investment. This helps to accelerate your return on your purchases. One of the key things to any business when they look at it, some of you have already looked at this in the past, or maybe you're starting up a business for the first time. You'll hear this term ROI, or return on investment. What that simply means is, how quickly can I put $1 in and get that dollar back? That's what we all look at any type of an investment. Unless you're the federal government, you want your money back. The federal government's not a for-profit business. But as it goes here, for all of us on this phone call, I think we're all profit-making individuals. None of us are a 501c3. That's a nonprofit company. So let me give you an example of how this will work. We're going to take a situation under a corporation structure. And we're going to say that the taxable income, after they've taken the revenue and deducted all of their expenses, be that for personnel, rent, utilities, materials, shipping, everything that's all there, that when they get all finished, they have a taxable income of $85,000. Now, under the federal corporate tax, that would translate to a tax liability of $28,900 on that pre-tax net income. So the government says, okay, you've created this revenue, you've deducted all of your expenses, you're left with $85,000 in the drawer. We want $28,900 of that payable to us for purposes of federal taxes. But during the course of 2015, you went out and you spent up to $25,000 worth of tangible property. That could have been cars for your fleet of vehicles. That could have been ovens. That could have been anything. Could have been a printer. But whatever it is, you get to deduct up to $25,000 of hard, tangible property monies, not expenses, but monies spent during the course of 2015. Now, do keep in mind, in prior years, that number has been as high as $500,000. So this has dwindled down over time. Right now, it has been stabilized at $25,000, and that will be it. As I mentioned earlier, there will not be this opportunity in 2016. This is the very last year. So had you done that in this example, instead of $85,000, you would subtract the $25,000 from that. Now you have a taxable income of $60,000. Under the corporate tax rates, now your tax liability is in the 25% tax bracket. That translates to $15,000 in taxes. That says by spending $25,000, you saved on your tax bill $13,900. Another way to look at that, as you can see at the bottom, is that that $25,000 purchase, after you take the savings of $13,900, says that piece of equipment or equipments, could be multiple pieces that that you bought, does not have to be $25,000 on just one item. It actually only costs you $11,100. Now I know that seems a little unrealistic, but it's the true aspect of how this Section 179 works. What it is saying is that for every dollar you spend on tangible personal property in 2015, before the end of this year, it's going to save you a lot of money coming back. And in this particular example, under a corporate structure, it's $11,100 is the actual net cost for that $25,000 worth of equipment. That's a great start on what we call the ROI, or your return on your investment. Now keep in mind, there's a few other aspects about the law and how you have to apply it. The equipment has to be purchased or financed or leased on or before the end of the year. You have to take receipt of the property or the equipment on or before December 31st. And it has to be ready to produce on or before December 31, or put into service, as they say. So today on the 18th, we have 31 days next month. We have 12 days left right now. That says within 42 days, if you want to take advantage of this particular benefit in the IRS tax code, you have to not only acquire the business, or acquire the equipment, excuse me, be it financed, be it a direct purchase, be it leased, but you have to take possession of it, and you have to have it in place, ready to go. It's got to be plugged in or set up or whatever it is. It can't just be sitting in a crate, sitting in your garage or in your warehouse, waiting to be installed sometime in January or beyond in 2016. You have to have it, has to be in, has to be plugged. Now, it doesn't mean that you have to be producing off of it. It just means it has to be ready to produce. So if you were to take possession of any type of an asset up to $25,000 in cost, and it's sitting there and it's ready to go on New Year's Eve, the fact that you have not produced one widget, made anything off of whatever you've acquired, is immaterial. The fact that it's ready to go is the key thing. It's the key element. Now, we were talking here about a corporate structure. Let's talk a little bit about personal tax rates. Many of you on this call may not be under a typical corporate structure. You may be set up as, say, an LLC or a partnership or even a sole proprietor. In this case, the same situation prevails. You do not have to be a corporation. You do not have to be an LLC or anything. You can be that sole proprietor. The same benefits flow to you. Now, the tax rates may be different. But if you're in an LLC, all of that taxable income flows over to you and your personal income. So if in addition to your business, let's say maybe that you're doing something on the side, maybe your business is in addition to a full-time job that you might have. If you're set up as an LLC or a partnership or a sole proprietor, all of that income from that entity will now flow over to your personal income. And it could take your personal income at one rate and now raise it up because you've included new profits from your existing business. The more that you can reduce the taxable income off of that business, the less taxes you will have to incur under the personal side. At the same time, if you're running this business, you might be subject to self-employment taxes, and those can be upwards to 15% when you have to pay for yourself and the matching fees that go along with it. This is for the Medicare set-asides. And so for that, those self-employment taxes are based upon the net income of your individual business. So again, if it's a sole proprietor, all of that flows over to you. You not only have a federal tax exposure, but you also have self-employment tax exposure. the more that you can reduce it through a Section 179 deduction to lower your taxes from a self-employment side. Many states also allow you to do the accelerated depreciation called Section 179 by flowing it from the federal to the state taxes. Now, every state is different. Again, you'll want to consult with your own tax practitioner, with your own CPA, find out, will you get the benefit not only on a federal, but will that also transfer to your state taxes? In a state like California, where we're based out here, where we can have tax rates as high as 11 to 13%, that can make a significant difference in additional tax savings that you can benefit from if your state allows that to flow over. But again, that is something you'll need to check with your own tax practitioner as well. Generally, there's a lot of questions that will come up from this. One of them is leasing versus purchasing. The law allows you, under the code, as I said, you can purchase, you can finance, where you're actually taking ownership and you have a note back to the bank or other financial institution, or you can lease. Many times, equipment leases are set up where you own the business at the end with a dollar payout or maybe a certain percentage of the residual value of the equipment that you're leasing. But in either case, it still qualifies. Now, again, this can increase your enhanced cash flow even more. If you go out and purchase $25,000, and in that example that we had where there was a savings of nearly $14,000 in taxes, you still had an out-of-pocket exposure of $11,000. That was still hard money that was out of your pocket. But let's say that you had leased that. That leasing or the financing would have allowed you to put a smaller amount of money down, maybe just 10%, and still get all of the benefit, even though you're still going to take several years to pay that back off. So again, you can start in with a purchase between now and the end of the year, where you can be approved for financing, leasing, take ownership of the property, generally not have your first payment due until 30 days after you've taken possession, which says that in 2015, you could actually acquire up to $25,000 worth of equipment, receive the tax benefit, and only pay a very small portion, which was specifically your down payment, and not have your first payment on your repay program until late December or into January, depending upon how your leasing and financing structure is set up, which says you can have that equipment in place, you can already start producing, you can start creating more widgets or whatever you're doing with that equipment and generating revenue while saving taxes, and you still haven't paid the full amount for the $25,000. So again, this is an enhanced cash flow approach. It's a much faster return on your investment. Again, things that you'll want to look at and talk with your tax consultant in so doing. I did mention the deadlines. All of this has to be done by no later than December 31st. If you were to, let's say, finance something late in December, got the approval, the ship arrives on January the 3rd, even though you had been approved, signed the papers, made a down payment, and it started to ship, if you didn't take receipt of it before the end of the year, you don't get the provision of the IRS Section 179 tax code. So it's important when you're looking at this to make sure that you're going to take possession in time so that you can meet that criteria. It would be a horrible shame that you go through the whole process of getting approved for financing or whatever you're doing in order to pay for any or all equipment, and then you wind up taking receipt of it 2 days after the end of the year. That 2 or 3 days could cost you thousands and thousands and thousands of dollars in tax benefits. As I also mentioned earlier, this is for 2015. Right now, this particular benefit in the IRS code is not going to be there for 2016 or beyond. There is a lot of talk about it. There has been some discussion, but as I mentioned, it has not been put into a bill. It's not even in committees. It's being discussed. In all likelihood right now, this probably, and this is just my opinion and the opinions of others I have spoken with, probably will not come about again unless as we go into 2016 or beyond, if the economy is not going at the rate that others would like to see it, they might come back and do this. But at this point, this is going to be your last year for the ability to do this. Again, financial and tax questions, these things you want to discuss in detail with your tax consultant. Get their input. There might be reasons not to take advantage of it this year. Some of you may say, well, I don't have any revenue to offset, so why would I want to do it this year? Well, let's just say you're an individual proprietor and you buy the equipment. You have little to no income in 2015. You're expecting to really launch your business next year. If you took advantage of it this year, yes, it would show a negative. There's no income tax on a negative. But let's say at the same time you have a regular full-time job or jobs, and that negative can either be offset this year against your own personal income and reduce your personal tax liability, or you can carry that negative forward into 2016 or beyond and allow it to offset revenues that you would have in the out years. So just because you might be thinking about starting up a business, you don't see the income coming for a while and think that this does not have application, I would not go that direction. I would consult with your tax advisor and tell them what you're thinking about and see how that plays in and what's best for you. All of you on this call will be different as to what your needs are, as to how it plays out for you. It might be different just because of how you're structured from a tax standpoint, whether you are a corporation, an LLC, partnership, sole proprietor, also even what state you're in. As I mentioned, California has a high state income tax. You have other states that have no personal income tax, but they have corporation taxes. All of these things are different every time you step across a state line. So again, we're not here to tell you this is how to do it, this is what it will save. It's something you need to think about and to explore with the people that are advising you in your business as you're going forward. So I've talked a lot up here over the last 30 minutes. Want to open this up to any questions that any of you might have. Looks like we've got a few questions on here. One question I've got is, would this money be tax-free from the IRS, or do you have to repay it back? Great question. No, this is a reduction in your taxes. This is not something that, let's say you bought your equipment in 2015, you depreciated it off. A couple years down the road, you sold your business or what have you. There might be a gain or loss on the sale of your business. Your tax advisor can counsel you on that. But this is not something to repay back. What you're doing, as I mentioned at the beginning of this webinar, is you are accelerating the depreciation that you normally would have had. Now that also means in the out years, you won't have that equipment depreciation to offset against revenue for the first $25,000. But if you bought $40,000, $50,000, $60,000 worth of equipment, you would still be able to depreciate the balance over and above $25,000 in the out years of 2016 and beyond. Got another question here. Let's take a look here. It says, well, it does ask, does this apply to the state of Florida where we have no state income tax? Again, I'm not a tax practitioner. I know that the state of Florida is a great state for purposes of reducing personal income taxes. They don't have a state income tax, as I understand it, as it applies to individuals. I could not advise you or tell you about other business entities and structures, or whether, if they did tax a corporation or something that was set up in Florida, whether you'd be able to take this and apply it to your own state income tax. It would be prudent for you, though, to talk to your tax advisor, as I've been repeating on this call throughout the day. Get their input, get their discussion, sit down with them. It's worth the time, it's worth the even the cost. If they charge you for 15 to 30 minutes worth of their time, it could save you tens of thousands of dollars. I'd make that call every day of the week. But again, what we're talking about here is any type of equipment. Many times on our webinar here, obviously we're talking about how to build your business with our equipment and the benefits of it. That's not our purpose today. We really want to be here to help you be strong in whatever you're doing, because your success ultimately is going to probably result in our success, whether we're supplying you with your equipment, ink, supplies, or what have you. But we just want you to be good, solid, productive folks going in. When you're looking at large equipment purchases, this is more than running down to the local Staples store and buying a small little printer, some paper, and supplies to start up a new business. Many of you on this call are looking at expenses that could be anywhere, or purchases, I should say, from $12,000 to $40,000. And when you do those kind of investments, you want to make sure you're doing it right. But at the same time, if there are ways that the laws are structured to allow you to get your payments back faster, so be it. Let the government help you in that financing. Let them help pay off that equipment in a faster rate. I don't seem to have any other questions on here right now, but I will tell you this. Each of you on this call probably have been or are anticipating talking with your regional sales manager here at our company. I would encourage you to reach out to them, talk to them about anything from this presentation today, and they would be more than happy to get you any other information. We will be posting this webinar out on YouTube here in a few days. So if you came in late to it, or there was something that was unclear, or that you'd like to revisit on this again, you'll be able to go out to YouTube and be able to see that in its entirety and have the opportunity to revisit this over and over again. I want to thank all of you. And if you're looking out there on YouTube, I've been told when you do the search, look for Anajet printers. And you'll get a whole plethora of various videos about us and many of the subjects that we present out there on YouTube. You'll be able to find this one out there. As I said, give it a couple of days. It'll be out there on YouTube for your use. Again, I want to say thank you. I appreciate your time, your understanding. Look forward to talking with any of you that are personally working with me here in the company. I'll be here in the office throughout the day and the balance of the week, here to take your calls. Please have a very good Thanksgiving holiday. We'll look forward to talking with you again. Thank you so much.